Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, the role of fundamental analysis. As I said earlier, really the premise is, and especially again, using these currency options longer to intermediate term, they can go out to, 10 months, 11 months, 10-month time frame, which is a pretty nice thing to have with an exchange traded, easy to see type of option. You can really play these fundamentals. You can let the fundamentals play out. And as I said, ultimately over time, the fundamentals always win out over time. And that's just the way it is. Currency markets tend to overshoot and undershoot, and the fundamentals tend to get out of whack. But that's what's important about understanding the role of fundamentals. If you can define the fundamentals behind a move, it doesn't mean you're trying to predict the fundamentals. You're trying to figure out what's going on here and what the consensus is looking at. And you can follow the fundamental trends. And there are definitely times when you can see a currency extends beyond its fundamental value, either to the upside or the downside. It doesn't mean you jump in and make a trade. It means you're watching very, very closely to see what happens. And when it starts to turn, as this turn starts to be made, and if there's a good technical setup, you already have the fundamental reasons, it's a pretty good high probability trade. And there's where the fundamentals can be used here. They're especially good at the ends, as I said, when things extend beyond where they are. Good example right now, the U.S. dollar. The U.S. dollar is extremely undervalued against most of the major currencies from a fundamental standpoint. Does that mean it's going to turn anytime soon? Not necessarily, but it could. And then after the fact, after it turns and rallies, all the analysts will come out of the woodwork and say, well, it was supposed to turn and rally. It was 27% undervalued against the euro. We expected it, but of course that's with hindsight. We don't want to use them that way. We want to use them really to understand what the consensus is looking at. That's our goal, is to get a handle on the consensus, because we can no better forecast currencies or forecast fundamentals than we can forecast anything. So the first goal is, what is the driver here? What does the consensus see as the driver in terms of the fundamentals? That's really our first goal, because ultimately what you want to do with this is, as the fundamentals start to play out as you're watching going forward, if they play out as the consensus believes, then watch price action. If the fundamentals play out and they surprise the consensus, there's a big surprise in the fundamentals, and the price action acts, as accordingly, that makes some sense. So you can just, the goal initially, the first goal, and I'll get to some of this more in a minute, is really just to understand the consensus view. Then, of course, as I just said, you're trying to evaluate the price action relative to the consensus. Simple example, and it's a powerful example. Good news and bad price action tells you a lot. If you get fundamentals that should validate the trend and you get bad price action accordingly, then you know something may be changing in the background that you don't see. And that's part of the problem with fundamental analysis, and part of the thing you have to be open to when the prices aren't validating the fundamental move, meaning there's a lot of stuff underneath the surface that goes on in the global economy that we don't see, and there's that portion that we do see. The portion the consensus sees is the portion they trade on, but often they make trades where price action isn't validating the underlying fundamentals. So that's why it's important to have a handle on these things as opposed to just the pure technical side of the fence. If you're looking purely at the technicals, you see it as a price move. You don't see it as a move that's validating or invalidating the fundamental consensus view. And I think that minor point, which sounds like a minor point, is very, very important in terms of trade setups, or at least giving you the idea of a potential trade setup. The other way we use fundamentals, and I think you can too, is really to build plausible alternative scenarios. Let me explain what that means. And again, it's something that we do here every day. John Ross and I not necessarily do it every day, but we build these alternative scenarios and track them every day. the consensus thinks, A, B, or C, if you can build a plausible alternative scenario that's different from the consensus, saying, well, C, D, and E actually may happen. It doesn't mean you're trading off your alternative scenario. It means you're watching your alternative scenario. And if things start to click into play to support this plausible alternative scenario that you created, it generally means you're going to have confidence to move faster than those that are trading only on the existing consensus view. Let me say that again. If you can build plausible alternative scenarios based on solid fundamentals in the future, and they start to play out your way, you're generally going to have confidence to move more quickly in the other direction than those that are, kind of deer in the headlights, what's going on type of thing. And it's an important thing that's really worked for us. As I said, you kind of look at it like this. Your consensus view really is the view. That is the trend. That's the driver of the trend. You build an alternative scenario, and what that does, it allows you to keep your mind open and to be flexible. It's the idea of trying to have two competing thoughts in your head at the same time. Can be hard to do, but if you do it, you'll find that as reality starts to play out, confirming your alternative scenario, you start to position into that trade. You're definitely going to get there ahead of time, and we've done that many times before, and it's helped us. We did it, a specific example, during the credit crunch. As it started to gen up the credit crunch, and let me just go through it very quickly, and I won't replay the whole credit crunch scenario. I think most people know it. But when it first happened, we saw the analysts being trotted across CNBC saying, well, this problem is just a little problem in the real estate market in the U.S., the subprime problem, a little corner of the U.S. Well, John Russ and I knew from our readings that a problem in derivatives, no matter where they are or how small, is a problem somewhere is a problem everywhere because they're interlinked. There's always somebody else on the other side. So that was one thing that clicked into our head when we started to hear that this small problem in the real estate market was just only a small problem that was going to be contained. As it started to fester, then the players got into gear and started to say, well, okay, this is now a big problem, which played out an alternative scenario. We thought it would become a big problem. It started to become. And their call was that it's going to be disastrous for the U.S., so therefore sell the U.S. dollar. But the reality is, if you understand global macro trade flows, currencies are driven by supply and demand of capital. They're driven by a lot of things other than just the headline news, fear and greed and people wanting to get out of positions. If there's a major global conflagration, meaning people are already started to realize that little problem in the corner of the real estate market was now turning into a global problem, but they didn't understand the global fundamentals that money flow is the driver of a currency regardless of anything else. And if this grew into a major global problem, people would start taking money off the table and hiding into the treasury markets, people from overseas, U.S. investors and local investors and big local investors in small emerging markets do the same thing because that's the best place to hide. So if that was the case, we thought that a lot of money flow would come in the U.S. So even though the U.S. was considered the cause of the problem and it was going to hit us hard and we had all the headlines, we believed the dollar would rally. And that's what started to happen and allowed us really to position into that trade in a very, very big way. Now, if we were only looking at the technicals, we wouldn't have really been able to position for that, or at least have the confidence to start positioning into that trade. And that right there is a perfect example of how we tend to use the fundamentals. And they're very good, especially on the bigger events like this when you find people that are very confused. If you can build plausible alternative scenarios, it just helps refine your thinking about the world. And just the process of doing it helps either validate or invalidate your current position. Because if you think about plausible alternative scenarios, it may say, hey, the reason I'm in this trade doesn't make sense. Maybe I should get out and save some money. If I'm wrong, so what? But if I get out or maybe change my stop or reduce my risk, that's what these alternative scenarios help you do, not only just from positioning into new trades, but from a money management perspective.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.